All right, let's get right into it. Welcome to today's Explainer, where we're tackling the blueprint of wealth, stress testing the 60/40 portfolio. Think about building your long-term wealth exactly like building a house. You wouldn't just slap some bricks together and hope it holds up, right? No way. You need the right tools, a rock-solid architectural blueprint, and most importantly, you have to know for sure that your blueprint can actually survive a hurricane. So today, we are taking the world's most famous, most heavily debated investment framework, and we're putting it through a brutal 122-year historical stress test to see if it still actually holds water. But first, we really have to address the elephant in the room. Is traditional investing dead? This is a question that's been bouncing around everywhere since the massive market crash of 2022. For decades, investors were basically taught a golden rule. When stocks go down, your bonds will go up. Bonds were supposed to be the ultimate, foolproof safety net. But then 2022 happened, and both stocks and bonds just plummeted at the exact same time. There was literally nowhere to hide. It created some very real, very deep anxiety for focused learners like yourselves who were just trying to build a secure future. That feeling of a fractured, icy landscape, that's exactly how shattered those traditional financial models felt to so many of us after that shock. The safety net didn't just tear, it completely cracked. But before we just throw the whole system out the window out of panic, we need to rebuild our confidence from the ground up. And that starts with getting a really clear grip on the very basics of what we're actually putting our hard-earned money into. Okay, let's jump into Section 1, the investment toolbox, getting back to the basics. Before we can even talk about the blueprint of a portfolio, we've got to understand the specific tools we're using to build it. Let's look at the two heavy hitters, stocks and bonds. According to the folks over at Abacus Planning Group, buying a stock means you are taking direct ownership in a business. It's clean, there aren't any sneaky management fees, but it is incredibly management heavy on your end. You've got to understand accounting, read through dense company filings, and just accept the reality that your investment could totally fail. On the flip side, buying a bond means you're basically providing a loan to someone, like a corporation or a government. As our source points out, buying a bond is actually surprisingly similar to buying a car. You have to be ready to negotiate with the dealer and really understand what your claim to the assets is if that entity goes bankrupt. And that brings us to a much more modern power tool in the box, the ETF, or Exchange Traded Fund. The absolutely crucial thing to know here is that an ETF takes the best of both worlds. It perfectly combines the pooling power and safety through diversification of a mutual fund with the super easy real-time trading of an individual stock. It relies on a concept called the law of one price, which is basically a built-in mechanism ensuring the ETF's trading price never drifts too far away from the actual value of the stocks it holds inside. It's a highly efficient, absolutely essential tool for building your financial house quickly and securely. Moving right along to Section 2, building your blueprint, factoring in age and risk tolerance. So, with our tools clearly defined, how do we actually put them together? This is where we move from theory into the real world, mixing these assets based entirely on your age and how much risk you can stomach. US Bank provides a fantastic, super simple guideline for this, called the Rule of 110. You simply subtract your current age from 110, and boom, that number represents the percentage of your portfolio that should be aggressively invested in stocks. So for a 30-year-old, 110 minus 30 is 80. That means their portfolio allocation is an aggressive 80% stocks and 20% bonds. Because we're all generally living longer, this rule allows you to keep a much higher percentage in high-growth stocks for a longer stretch of time, which is a sharp contrast to the much more conservative mix you'll naturally need as you get older. Let's just do a really rapid chronological journey through the decades to see how this evolves. In your 20s, you're looking at something like 90% stocks. You have decades to recover from any wild market volatility, so you want to be incredibly aggressive to capture that sweet, sweet compound growth. By the time you hit your 40s, you dial it back to around 70% stocks, focusing heavily on maximizing those 401k contributions and absolutely taking advantage of any employer matches. Free money, right? And by your 60s, you're down to 50% stocks or even less, shifting heavily into bonds and cash equivalents. Because at that point, you're not just trying to grow wealth, you are protecting it and maybe even doing a test run of your retirement income strategy. Which brings us to Section 3, the 60/40 stress test. 122 years of data. We've looked at the personal timeline, but what happens when we zoom out and look at the global timeline? By digging into the CFA Institute's massive study, which covers a staggering 122 years of market history, we can see if this classic split actually survives the real world. And believe me, the tension right now in the financial industry is completely palpable. We have two of the world's most massive asset managers fundamentally disagreeing with each other. Vanguard looks past that brutal 2022 crash and says the 60/40 portfolio is poised for another strong decade since valuations are finally back to reasonable levels. But then BlackRock looks at the exact same data and flat out declares it's time to consider alternatives, suggesting that bonds are just no longer the reliable diversifier they once were. So who's actually right? Let's let the historical data answer that. When we dive into the records, we see that geography massively, undeniably impacts the stability of your foundational blueprint. The historical numbers on domestic 60/40 portfolios from 1901 to 2022 are wild. Look at the incredible resilience of Australia and the US. They're boasting nearly 5% mean annual returns with the smallest maximum drawdowns, and by drawdown, we mean the absolute worst loss from peak to trough. The US drawdown was roughly 45%. Ouch, but survivable. But then consider Japan. A modest 2.95% return over that century, paired with a devastating, completely portfolio-crushing 97.74% maximum drawdown. The country you choose to build your financial house in matters immensely. And the historical data shatters another major misconception, too. Remember that foundational assumption of the 60/40 mix? The idea that stocks and bonds have a negative correlation, meaning when stocks go down, bonds automatically go up to save you? Well, the CFA Institute data reveals that is actually historically false over the long run. Over those 122 years, the correlation in the US was actually a positive 0.19. In the UK, it was 0.49, and in Europe, a whopping 0.62. They are positively correlated. They actually often move in the exact same direction over the long term, which completely reframes how we need to view portfolio protection. Section 4. A generational divide. Let's talk about exactly when you were born. It turns out portfolio success isn't just about the tools you use or the country you live in. It is heavily dictated by exactly when you were born. The historical contrasts across generations are just stark. If you were a baby boomer starting your investment timeline right around 1950, you magically avoided the Great Depression. You bypassed WWI, and you rode this massive, unprecedented post-war economic recovery. Boomers saw incredible real returns, averaging 6.7% globally for equities. But fast forward to the millennials, starting their journeys around 1990, they walked right into the dot-com bubble, the terrifying 2008 financial crisis, and then COVID-19. The returns are visibly, painfully lower across almost every single metric. So synthesizing all these complex realities is absolutely crucial. Baby boomers undeniably experienced the most favorable market conditions globally in modern history. Millennials broadly had a much, much tougher starting point. To put that into perspective, if you were a millennial investor in Japan, the economic loss decade of the 1990s meant your real equity return from 1990 all the way to 2022 was actually a negative 0.3%. The 60/40 mix was your one and only saving grace there, basically dragging your overall portfolio up to a modest 2% gain. However, the data also shows a silver lining. The geographic stability of the US and Australian markets provided vital insulation, maintaining surprisingly stable 60/40 returns across all the generations, completely despite those global crashes. But honestly, despite the generational bad luck of some eras or the severe geographic risks of others, the long-term data is just awe-inspiring. Think about the cumulative wealth of the 60/40 portfolio over 122 years. If you had invested just one single unit of your local currency into a 60/40 portfolio in the US back in 1901, it would have grown 339 times by the end of 2022. In Australia, it grew 280 times over. Even with two world wars, the Great Depression, oil crises, and global pandemics, this is the undeniable mathematical proof of the staggering long-term power of a globally stress-tested 60/40 blueprint. Which brings us to the final and definitely the most important question of this entire explainer. What is your timeline, your risk tolerance, and your unique generational context? The 122 years of historical data absolutely proves that the 60/40 blueprint isn't dead. But it also proves it isn't some magical, flawless shield either. It requires you to intimately know your tools, to understand the risks of your geography, and to clearly recognize the economic era you are actually building your wealth in. So as you look at your own financial house today, I want to leave you with this. If the last 122 years of history proved that our geography and our generation dictate our wealth just as much as our actual choices do, what historical era are we blindly walking into right now? Take these blueprints and start stress testing your own future.